Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be going over the pattern trading versus discretionary trading. Which is the better approach, and how can we use this information to our advantage? So before we start, we have to understand what the difference is first. What exactly is pattern trading and what is discretionary trading, right? So pattern trading is... Well, kind of as the name would imply, but pattern trading is using repetitious market patterns to place trades off of. That could be a Fibonacci pullback, it could be Ichimoku clouds, it could be whatever the pattern happens to be, but there are a repetitious pattern that you can count on with certain results that, again, you can count on. They have no bounds or attachment to the current market context. News, fundamentals, those are totally irrelevant. It's a specific pattern that sets up, so you can execute a trade off of that pattern with a long-term statistical reliability. Or at least, again, that's the goal. So then, what is discretionary trading? Discretionary trading is taking into account the current market fundamentals and the psychological state of what's going on. Why are traders likely doing what they are doing? Why are we looking at the market in terms of maybe bulls getting trapped or bears looking for a push down and a stop run? Those types of underlying causalities, why would those be taking place? Where are they likely entering, exiting, taking profit, stopping out, and everything in between? Discretionary trading is following the normal market patterns, but attempting to dissect them for further understanding as to why this pattern would work over another. Reading the market as though it were a story rather than just a pattern with probabilities. So then the big question, which is better? Here's the thing. In almost all scenarios, we have to approach this question as a blend. And we talk about it all the time. It doesn't matter if you're comfortable with a trade. If we know our edge, we have to show up to the party. Well, that's pattern trading, right? To a major degree, yes, but within that pattern of trading style, we can implement solid rationale and reasoning as to why the market would want to do what we want it to do. This is the pinnacle of the trade, right? If the trader is not able to find a valid reason as to why the market would want to respond in an area, then the trade shouldn't be taken, right? If, however, a trade can be explained, the trade must be taken because there's no gray area anymore. This is when you absolutely have to show up to the party regardless of how you feel about it. We have our edge, now we strike. And that's where the real power comes in. By blending the two together, we can create scenarios that increase our likely probability of success by 1 to 5% on every trade. Ooh, 1 to 5%, right? I can hear everybody like, what, really? Yeah, seriously, that may not seem like it's much, but if you assume an entire year worth of trading and a long-term probability structure that adds 1 to 5%, that's everything in the world. That is a monstrous difference on your bottom line. So when we can look at this type of formation and blend them together, as an example, if we're rotating to the downside and I'm expecting a certain scenario to take place, then I would want a reason to believe that, once we get to that place, well, the job should be done from one perspective. We should be switching gears. We should be creating a scenario. Yes, we may be in a zone of interest, but is there proof? Now, if we zoom way far out here, obviously this is the current market and we're at a previous major swing. But let's say, as an example, we're trying to find something else that makes a bit more sense. Something that has context that's both structural as well as a bit of discretionary in terms of the entry. This allows us the benefit of all of the different worlds available, right? So if we're looking at this from a channel perspective, rising support, looking for the market to want to come in, and that happened right there. Now, from a structural perspective, sure, yeah, I mean, we're at the bottom of a channel. Just buy it, right? Good enough. Well, not necessarily. Yeah, in this case, if you would have just bought it, eventually it would have worked out, but you would have had to have dealt with all of this other garbage. So the discretionary side of things, or the discretionary side of me, comes in and says, well, wait a minute. I want a reason to want to be a buyer here. I don't want to just buy because we're in a zone. That's not good enough. Not unless that zone has a lot of things stacked up. So if we're looking at this area, what things do we have to our advantage? Well, we've got the low of the channel. We've got a possible double bottom from before. They're all stacking up in the exact same spot. Okay, now As far as the bulls are concerned, they have a reason to strike. But are the bears done? This is one side of things that a lot of traders don't look at. Yeah, they might be in a zone of interest for them to be a buyer, but are the sellers done selling? And that's where the discretionary side comes in. Usually with discretionary trading, I'm waiting a little bit later. I want to gain some proof. The sellers drove down. We rotate back up, big push down. Now look at where the support is coming in. Okay, now we've got a reason to potentially believe them. They come back. We demonstrate more support. I have even more of a reason to believe them. The sellers are trying to get this to go lower through the channel, and they are unable to do so. And eventually, depending on the pattern that you're looking for, in this case it would be a wedge, but we get the break of the wedge and the continuation to the upside. Yes, there's a pattern here, but is there an explanation as to why this could be occurring? Yes, we have sellers who are trying to get the market to rotate down, and they are failing, and they are giving up. So when they start giving up, in a zone of interest at a channel low with a wedge, now we're starting to stack everything together. We're blending them so that we have the highest probability to our advantage. So that's going to do it for this one. I hope you found it useful, interesting, entertaining, and maybe something that you can really consider modifying or adding into your tool belt or trading repertoire, because pattern trading in and of itself is an incredible approach to the market, but we're not machines, and we make mistakes because we're not machines. We are not ones and zeros. We're a lot of little decimal places in between there. And by blending in the differences with those little decimals, if you will, we'll keep that analogy going, by blending them together, we can hone in on the precise moment when the market should be changing gears. And we can explain those areas, and so long as we can explain them, we need to show up to the party. As always, if you have any questions, feel free to drop them in the comments below, or if there is a more detailed question that you need a response to, feel free to shoot me an email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we will see you all then. Thanks.